Bloomberg Audio Studios.
Podcasts, radio, news.
Joining us now, the former Vice Chairman of the Federal Reserve System with PIMCO, and of course, forever herder of cats at Columbia University within their Department of Economics. It's going to be a 4-hour conversation, and we're only doing it a short block this time with Vice Chairman Clarida, but we'll make it a much longer conversation next time. I want you to recapitulate your Economist article of 7, 8, 9 months ago, where you shook the industry by saying, forget about 2.00%. It's going to be some number higher. Revisit that right now.
Well, thank you, Tom, and always great to be on the show, especially in studio. Yeah, in that essay, I highlighted that I thought the Powell Fed and really global central banks were really aiming to get inflation down to what I called 2 point something. And the idea was inflation was up to 5, 6, or 7 at the peak, and the goal would be to get it in the zip code of the inflation target. But in terms of dealing with the last mile, to let the economy sort of get to the last mile on its own without another leg up in rate hikes. And that's what I think we're seeing in the U.S. and really around the world.
Is the Fed restrictive now? The polarity of market economists we speak to is there's a select group saying, you know what, they could go up further and then come down. And there's others saying, stop it. They're way above the real rate. Bring it down now. Which is it?
They think they're restrictive. I think they're restrictive. I think there can be a debate on how restrictive. The Fed's thinking, which I think makes sense, Tom, is that the longer they keep rates here, and importantly, the longer they signal they're going to keep rates here, they will become more restrictive. And so, yes, I'm certainly in the camp that they've done enough. And the real question is, how long do they have to keep rates at this level?
Rich, Tom and I will speak to people both in academia and in practice that says, the Fed should be cutting now. If you look at the real-time data, inflation is maybe not whipped, but we're pretty darn close, and we should be cutting rates now. How do you think about that?
If I were still in the building, I would not be in the camp to be cutting now. It certainly looked like that was feasible coming into the year, but since the beginning of the year, the inflation numbers have been going in the wrong direction. And also, I think that, especially I think what's relevant here is an element of risk management. So I think there is path dependence. The fact that the last 3 years inflation has been well above target, I think it makes it a harder call to cut preemptively. So I do think, sometimes central banks say they're data dependent and they're not. I do think the Powell Fed now is data dependent, and I think they're ready to cut if the inflation data starts to proceed as they expect.
How do you think this Fed is looking at the labor market? I mean, Tom and I, we kind of throw out this term. It feels like we're at full employment. Everybody who wants a job kind of has a job. Yeah. Wages are going up and at a pretty reasonable pace. How do you think the Fed looks at the labor market today?
I think they see a labor market that is robust by a variety of measures, not just the unemployment rate, but other indications. And that's a good thing, indeed. I think one of the first speeches I gave as vice chair, I made the point, the Fed is not targeting wage inflation. It actually likes it when folks get a nice raise, but raises have to be consistent with the inflation target. And we've gotten some good news on productivity in the last year. Productivity growth is now around 2%, and 2% productivity growth with 4% wage increases, if sustained, gets them pretty close to where they want to be. So I don't think there's a lot of adjustment required in the labor market from here.
If you're joining us right now, Richard Clarida, former Vice Chairman of the Fed, and of course with Columbia University. You're a certain kind of monetary economist, of course, with DSGE with Jordy Galli. And I think of Meghnad Desai over at the London School of Economics coming from a totally different world. Lord Desai got so upset about our fiction of equilibrium that he wrote a book about it, 2008, 2009. In DSGE, there's a respect for Walrus in some form of normal equilibrium. How can we measure equilibrium now if we don't have a clue what productivity is doing? I just don't buy it.
Well, I think we measure it with pretty big error, Tom, and you're absolutely right that not just productivity, but a lot of inputs into theoretical DSGE models, R-star, term premia, equity premium are all unobserved and measured with error. So I always thought, and I've said this on your show, and I've said this in the halls of the Fed, models are a place to start, but not to end the conversation. And in particular, folks would criticize, say, DSGE, that they're 3 equation models. Well, I think every economy needs to have at least 3 equations, but there are a lot more. So Tom, it's a starting point, but it's not a destination to get to the answer.
But the 250 PhDs, whatever it is at the Fed,
at least,
they've all studied Clarida, Galley, Gertler, and the rest of it.
Yeah.
I get it. They've studied this stuff.
Yeah.
Is it germane right now? Our listeners say, you got to be kidding me. After the shock of a pandemic, a triple stimulus, throw the equations out. Does Chairman Powell have equations now that are effective, that have some form of use?
My sense, obviously, from public comments of not only the chair but the committee, is that they've understood, Tom, for some time that the shock was sufficiently unusual and substantial that they can and they are relying less on models and more on the way the data evolves. Tom, on one hand, the models were telling them that to get inflation down from 5.5 to 2 point something, they'd need to have a big increase in the unemployment rate. And both Governor Waller, Chair Powell, and others said, look, the economy may be different this time. We don't have to assume a big cratering in the labor market, and that was actually a positive development.
I can't say enough, Paul, how I agree with this. And then Powell's been hit like a piñata. Powell led saying, do we really trust these equations? And Clarida, who invented the equations at Columbia, Stiglitz, they got their equations. Some of them are real simple, like Stiglitz and Grossman, and others like Clarida, it's Greek to me. Yeah. But the answer is, do they matter right now? And Powell's led on this.
I know, and Tom, one of the key issues for a lot of folks is the consumer here. I mean, there's a tale of 2 cities, if not more, out there with the U.S. consumer. A lot of folks are really struggling, particularly if they don't own assets, whether it's real estate or stocks or bonds and things like that. And how does the Fed think about the consumer here? How do they gauge how the consumer's doing? They look at the earnings from Walmart. I mean, what do they do?
Well, the Fed staff devotes a lot of resources to the consumer, not only at the aggregate level, what is total consumption, but also increasingly during the time I was there, focusing on the distribution, both income and consumption distribution across the population. And there are a lot of things that you can monitor, in particular, how many households are late in their car payments or credit card payments. And so certainly the Fed spends a lot of time on the bottom-up analysis of the consumer.
So again, we came into the year, Richard, I mean, the market was discounting 6 rate cuts. Now we're down to less than 2. I mean, the market has no idea what's going on out there. Is the Fed, from your perspective, are they happy to say, hey, we've done a lot of work here. We've raised rates. We had a major impact on this economy. Let's just wait and see how our work plays out. Is that kind of where we are, do you think?
That's exactly where they are. In fact, the chair got that question at the press conference, and I'm paraphrasing, but his answer was along the lines of, we judge that policy is restrictive, and we judge that if we keep it here long enough, it will be sufficiently restrictive. So that's definitely their mindset. They're data dependent in terms of when the cut and how many cuts are going to happen, but they certainly judge that policy is restrictive here, and they just have to keep it here.
One of the great moments now in economics, Professor Clarida, is your colleague in crime at Columbia, Joseph Stiglitz, Nobel Prize winner, is out with a wonderful new book, very thought-provoking, should be read by conservatives, The Road to Freedom, Economics and the Good Society. You two are both victims of the Midwest. And one of the great advantages here is Clarida and Stiglitz are like, would everybody calm down? There's a whole nother country out there.
Yeah.
Tell me about policing as Dean of Columbia Economics, Joe Stiglitz. I can't fathom that is your day job. What was it like telling Joe Stiglitz, you will teach this course?
Well, no, look, Joe is a treasure, and I'm actually proud of the fact that when I was department chair back in 2001, I recruited Joe to Columbia. It was one of my big big accomplishments. I'm an enormous fan of his research. He's an incredible colleague,
Right.
incredibly creative, and I just wish we had 50 more Joe Stiglitzes, with or without the Nobel Prize.
Why should conservatives read Stiglitz' The Road to Freedom?
Well, I'm reading it now. I listened to a podcast the other day. Look, it gives, I think, an informed and nuanced assessment of the power that economics can have about thinking about the world if you're willing to step away from the oversimplifying assumptions. And much of Joe's career has been driven by a curiosity about the world and providing a structure to think about it.
How do you think about this U.S. economy? A lot of we hear recently about the exceptionalism of the U.S. economy vis-a-vis Europe. Let's think Germany, or Asia. Let's think China. Is this something that is unusual, this kind of decoupling, if you will, in terms of performance?
You know, that term means different things to different people. What is clear, I think, is through the rearview mirror. Last year, many predictions of a recession. Not only did a recession not happen, but growth was a point above trend, a very hot labor market. I think part of the exceptionalism theme relates to excitement about AI. AI is a big deal. It's not clear if it'll be a big deal in the next 6 months or 6 years, but it is a big deal. And obviously, U.S. companies and U.S. innovation are poised to benefit from that. But there's another dimension, I would argue, in which the U.S. is exceptional, but in a poor direction, which is that we have an exceptionally irresponsible fiscal policy. And if you look at the CBO numbers, they are frightening. Essentially, deficits of 5, 6, 7% of GDP as far as the eye can see. So exceptional in multiple directions, I would say.
One final question.
Yeah.
We have a presidential candidate, a former president, who basically wants to take the independence of the Fed away. From your reading of our political economy, can a single president remove Fed independence?
Certainly not. I think the legal standing of that issue is clear and decided, and I would. 2 points. One, Jerome Powell will serve out his term, which goes through May of 26. Secondly, there are no vacancies on the Federal Reserve right now. So for the foreseeable future, there's nothing for a future president to do on that account.
This has been fun. Did we do okay?
Yeah.
We get a quality C.
Yeah, gentlemanly C. I'll take that.
Richard Clarida, thank you so much, of Columbia University and, of course, the Fed, and with PIMCO.
Thank you, fellows.
As well.